Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about how to explore chart patterns and how they can guide your day trading strategy. Now you will learn how to identify these patterns, you will learn how to use them effectively and how to avoid common mistakes that can derail your trade. So watch until the end of this video to gain a clear step-by-step approach to incorporating chart patterns into your trading routine. We start by understanding what the chart patterns are, and these are visual formations created by movement of price on trading charts. They reflect the ongoing battle between buyers and sellers in the market, helping you understand where the price might head next. Now, these patterns are formed over time and are used to predict potential reversals, continuations, or even indecision in the market trend. Now, there are three main types of chart pattern you should know, and these are reversal patterns that signal a change in the current trend. For example, if price has been trending to the upside, as you can see in my chart, price has been trending to the upside. A reversal pattern might indicate that the downtrend is about to begin. So continuation patterns suggest that the current trend is likely to continue after a brief pause. Lastly, bilateral patterns show that the price could break out in either direction, and this requires confirmation before taking action. Okay, reversal patterns are such as, let's say, the double top, the double bottom. They are common examples, and as you can see on my screen, this is a typical example of a double top. This is a reversal pattern, shows that the bulls are losing strength in the market and bears are coming in to take control in the market. This is the neckline on the pattern. The double top is formed when price reach the highest point twice but fails to break through, signaling potential down move. On the other hand, the double bottom forms when price hits a low point twice and struggles to go lower, indicating an uptrend might follow. So this is a good example of a double bottom. Price was trending in a downtrend, then it came over here, made a series of reached the lowest points in the market twice but failed to break. This results in a reversal signal to the up direction. Now, for continuation patterns, consider an ascending triangle. For continuation pattern, we'll talk about an ascending triangle. Now, this pattern occurs when price have formed higher lows but repeatedly testing the resistance area. And as you can see, price is forming higher lows at this area, higher low, a higher low, a higher low, but repeatedly testing this resistance region. This often signals that price will break upward in line with the existing trend. And as you can see, the existing trend, it was a trend to the upside, that it was a bullish trend. So bilateral patterns like the symmetric triangle are literally different. The price narrows in a tighter range, forming higher highs and higher lows. Now let's look for an example of a symmetrical triangle. Now this is an example of a symmetric triangle, and they are slightly different because price are being narrowed in a tight range. They are creating lower highs. These are the lower highs they are creating, and at the same time they are creating higher lows. So higher lows they are creating. Now this means that the breakout can be in either the up or down side depending on the market sentiment. So you have to look at the overall market condition before deciding which direction the breakout is coming from. As you can see, this market was trending to the downside, meaning that the breakout definitely would have occurred in the down direction. So understanding these patterns is essential because they will help you identify opportunities and manage your risks more effectively. Now let's look at some strategies we can use with these chart patterns. Day trading strategies usually involve specific formations on your chart, confirming their validity and executing trade based on clear entry and exit rules. Now, this strategy is designed to take advantage of short-term price movements while managing risks effectively. Now we begin by scanning through the chart for a well-defined pattern such as a double top, a flag pattern, or an ascending triangle, which have already been marked out at my chart. You can see this is a flag pattern, a double top, any of them. Now for the double top pattern, we have to wait for price to test the resistance twice, which has already been marked out here. The key is to enter a short trade only when price break below the neckline. So this would be our neckline, and the moment price breaks below our neckline, this will be a good area to enter a short position. Once price has broken and closed below our neckline, you can enter your short position. You place your stop loss just above the second peak, and you set your profit target to the same length as your pattern. You just need to measure the length of your pattern, and you set your stop loss to the length of your from your neckline to the height of your pattern, which will give us an approximate of 1:1, as the case may be. Just set your TP at this area, or you can still go for a standard 1:2 or 1:3, as the case may be. Now, for a continuation pattern such as your flag pattern, you usually identify a strong trend prior to that, and as you can see in this area, there's a strong trend to the upside where price was making higher highs, higher lows, higher highs before we saw our flag pattern. Now the breakout of the flag is usually in direction with the trend. It signals a potential continuation. So you enter your trade after the breakout and you place your stop loss just below the consolidation zone, and you use the length of the flagpole to estimate your target. So you will enter the moment price breaks out. Remember, your stop loss will be placed in below the consolidation zone. This is the consolidation zone. So you place your stop loss just below the consolidation zone, this area. Then you aim for the height of your pattern. That can be your take profit region. Take profit region is the height of the pattern, or you can still go for a fixed risk to reward of 1:2 or 1:3, as the case may be. Now the next one we are going to talk about is for the ascending triangles. For the ascending triangles, you need to watch out for higher lows forming against a flat resistance. Like you can see, this is a flat resistance, and you can see the formation of higher lows in this area. The breakout is always above this resistance because it confirms the pattern. So you are expecting the breakout to occur above the resistance that price has been finding it difficult to break. So you enter a long position after the breakout. You set your stop loss just below the recent swing low, the recent higher low. As you can see in this area, this is the most recent higher low. Then you aim for the height of your triangle. The height of your triangle can be your profit target. You measure the height of your triangle and you use that as your profit target, which will give us a 1:1.5 as the case may be. Now, volume can also play a crucial role in confirming this pattern. Now, a breakout accompanied by a strong volume or a high volume is reliable. So most of these times, let's add our volume indicator to further help us confirm any trade setup we're about to take. And as you can see, when we took this flag pattern at this area, you can see it was accompanied by the volume. There was an increase in the volume at the flag pattern. This shows that our trade is being backed up by volume. Now, when we took this our double top, adding my volume indicator to see if we have the backing of our volume, and as you can see, when price broke out from the neckline, we can see it was accompanied by a high volume. This means that volume can also play a role when you see your setup and it is being backed up by a high volume. It is more reliable. But once you see a low volume, you'd have to avoid fake signals. Remember, risk management is essential in this strategy. Never risk more than a small percent of your trading capital. On any single trade, use a stop loss order consistently and aim for trades with favorable risk to reward, such as a 1:2 or 1:3, as the case may be. Now, there are some common mistakes we need to avoid. Failing to confirm a chart pattern is one of the most common mistakes. Jumping into a trade without waiting for a breakout or sufficient confirmation can lead to a false signal and unnecessary losses. So always wait for your pattern to be fully formed, and this will help you to further validate your chart pattern. Remember, you can also validate this by adding additional indicators such as our volume that we just added to our chart. You can also make use of trend lines before making your moves. Now, ignoring the overall market trend is another crucial error, solely because individual chart pattern without considering the market context can lead to trades to go against the prevailing area. Now let's see an example, and as you can see in this area, if we are to take this double top at this area without seeing the broader market condition, we would have been faked out. If we did not wait for price to break through the neckline, without our confirmation, we would have been faked out of this trade. So we always need to wait for our confirmation to align with our trade. Now, another mistakes we make is overtrading. Overtrading is a mistake that can drain both your capital and your emotional energy. So seeing patterns everywhere and trading excessively may lead to a poor decision making. So you have to stick with your trade plan and focus only on high quality setup that meets your criteria. Like this double top we saw here, we have to wait for our confirmation that it will break this neckline before we decide to take our trade. So without it breaking this neckline, no trade. That is how you should apply this to your trade plan and stick to your criteria. Remember, setting your stop loss tightly or too widely is another issue. Your stop loss should be set at an area that invalidates the setup. When it's too wide, it exposes you to larger and unnecessary losses. So always place your stop loss at logical levels based on your structure pattern. In a bullish trade, you have to set it below support region. In a bearish trade, you have to set it above your resistance region. Such as if we are to take this area, this trade at this area below the neckline, once you have entered your trade, you set your stop loss above your resistance region. This is a befitting area to set your stop loss. Now, failing to adapt to changes in market condition is something we should avoid. Markets are dynamics, and work in one environment may not work in another environment. What works in one environment may not work in another environment. For instance, patterns that perform well in a trending market might fail during a ranging market. So you need to understand and adapt to the changes of market, of certain market condition, to avoid unnecessary losses. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you have found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thanks for watching, and I will see you in the next video.